I'm privileged today to have an amazing guest and an amazing conversation. I say guest, but this is it's not even my podcast. It's sort of my studio, but we are here to discuss really important stuff. Nick Cox, thank you for coming from Vancouver to sit down to talk about something that's super important, an amazing topic that is current across Canada for anyone that owns a house and anyone that wants to plan for retirement, and any professional that works with Canadians towards that goal.
Yeah.
To talk about the Smith Manoeuvre, which we both collaborate and work strongly and effectively together every day.
Yep.
So thank you for being here.
It's awesome to be here and to finally meet you in person. We've been working together for 2 years, so to finally get to hang out, it's been really great the last few days.
Yes, we were at Ottawa at a national conference where we spoke to many professionals, mortgage brokers across Canada about the Smith Manoeuvre and all the amazing things that the Smith Manoeuvre and all its accelerators or levers can do for Canadians, for mortgage brokers clients, for financial planners clients as well.
Yeah.
So let's jump right into it. In your words, because this is the first time we're talking together, we often do it together to everyone else, but in your words, like what is the Smith Manoeuvre and how can it help Canadians, but also how can it help mortgage professionals, financial planners, CPAs define themselves, define their businesses, and really have an impact or a larger impact on their customers and their clients?
Okay, so if we were to go just very simply, the Smith Manoeuvre is a debt conversion process.
Yeah.
So we're converting a non-deductible debt, typically on someone's primary residence, into a tax-deductible investment loan. Now that sounds pretty boring, and most people are like, okay, I kind of get it, but the ramifications of that process are quite remarkable in how it can help Canadians. And so something the Smith Manoeuvre has been around since 1983. It caught on like wildfire after 2002 when Fraser Smith wrote the first book.
Yeah.
And it's become, I think, even though it's been around for 40 plus years, it's more relevant in the current economic climate than it's ever been. Since 2008, we've seen, housing prices increase, percentage of disposable income that families need to service housing costs is huge. And so strategies that can help Canadians get ahead financially that don't require additional cash inputs is something that we should really be unpacking. And so I think the Smith Manoeuvre in the current economic climate is more relevant than ever. And that's, something that you and I have in common. We're really passionate about how it can help mortgage professionals, financial planners, and accountants come together to provide integrated support and advice for Canadians. And it's kind of slipped through the cracks, and there's a number of reasons for that. We'll probably unpack it.
Yeah.
But I think it's a very relevant strategy. It's a completely legal tax strategy. And it has, sorry, I'm probably going to riff here a little bit.
No, you can riff.
It actually has, the interesting thing with the Smith Manoeuvre is that it sits at the cross-section of three disciplines. So it essentially utilizes the CRA's tax rules in order to function. It's really solid financial planning, but it has to be executed through a mortgage strategy.
Yeah.
And typically these three industries, accounting, financial planning, and mortgage brokering or loan origination, operate in silos without...
Separate silos.
Without integrated advice. And, when wealthy individuals often have teams, right? They have accountants and financial planners and lawyers that work in sync with each other. The Smith Manoeuvre is something that is really relevant for all Canadians to get the kind of integrated approach to their debt that wealth that's generally reserved for wealthy people with teams.
Agreed. Let's back it up because a lot of people will listen and be like, okay, I sort of hear what you're saying, but let's unpack it. If I'm a Canadian,
yeah.
So let's start there. If I'm obviously you have to live in Canada. So if I'm a Canadian or a Quebecer, or if I'm a professional mortgage broker, financial planner, CPA, which we provide the accreditation for the Smith Manoeuvre.
Yeah.
Let's unpack it very clearly for them in like 30 seconds. What is the Smith Manoeuvre exactly? Because there's so much misinformation out there. And I think it's important that everyone that's listening to this clip or this part understands what is the Smith Manoeuvre officially. Now, implementing it is something else, but what is it precisely? I'd like to hear in 30 seconds, if you had to tell someone really quickly and they get it.
Elevator pitch.
What would you say?
We're using a process to convert that non-deductible mortgage into a tax-deductible investment loan. And there's a specific process we go through. As you pay down the mortgage, and we have a specific a structure in place where as you pay down the principal, it creates room in what's called a home equity line of credit. We take that money out and we invest it. Two things happen. We've instantly created a tax deduction, and we're also repurposing principal for it that's going to go back out into the economy and earn income and growth.
Exactly.
And the impact this has over someone's lifetime, over the amortization of their mortgage, is huge. And the two key points, and I think this is the subtle beauty that I love about it so much, is that you do not increase the Canadians' debt by a single cent above the debt they've already taken on board, and it requires no additional cash inputs above the existing mortgage payments.
Not even to service the home equity line of credit.
Not even to service. So you've got this beautiful self-funding mechanism that allows a Canadian to save on taxes, save on interest costs, create wealth over their lifetime that doesn't require additional cash inputs. And when life is so expensive, that kind of help is very needed.
For a Canadian that's looking at saying, okay, this is interesting, or for a financial planner or a mortgage broker that's looking for the right avatar, there's a lot of misinformation out there as well. For example, someone in Quebec wrote an article about the Smith Manoeuvre recently. Said, well, this is only for someone that has maxed out their RSPs, maxed out their TFSAs, has high income and high risk tolerance. And that is the exact opposite of who's it for. So what is the need? What is the need that the Smith Manoeuvre is filling potentially? Why would it be appropriate for a financial planner or for a mortgage broker or for a Canadian to implement this? And for people that are asking themselves, well, is this for me? And how do I determine if this is something that makes sense for me?
I think, first of all, every Canadian should be given the option to offset their mortgage debt with an investment strategy based on the philosophy and the process of the Smith Manoeuvre. And so I think I might have lost a part of your question there for a second. I went off on a tangent. Can you just repeat that last part? So we were talking about the relevance. You have to say it
for
again.
The avatar. It's with the avatar. So for a Canadian, don't worry, we cut this up anyways.
Yeah.
So for a Canadian or for a financial planner that is trying to figure out, well, is this client appropriate?
Yep.
What is the appropriate client that should be considering potentially this might be for me?
Love it. So for starters, let's address the person that wrote that it's only for people that have maxed out their TFSA and RSP, right? So those, if we can think of those as being in isolated buckets, TFSAs and RSPs require the Canadian to have additional cash flow above, they have to have money left over in order to invest.
After they've paid their everyday bills.
Exactly. So they're either making the pre-tax contribution to the RRSP, or they're doing post-tax contribution to the TFSA. But it's based on the understanding that consumer has additional cash flow in order to do that.
Agreed.
We all know with interest rates rising, increasing consumer debt, people are really struggling to actually save for their future. And the Smith Manoeuvre requires no additional cash inputs. So it allows a Canadian to invest without changing their cash flow. So it actually has nothing to do. It doesn't matter whether you've maxed out your RSP, TFSA, or whether you've contributed nothing. It's actually relevant for every Canadian that meets the following criteria. One, you have to have a conventional file. So you have to have a property with at least 20% equity. If you have a property with 20% equity and you can income qualify for a home equity line of credit, a lot of us know that the qualification for a HELOC is a little bit higher than just the standard mortgage. Yeah. But that's really the base foundation.
You need to have a home equity line of credit.
Home equity line of credit that is automatic limit increasing. So as you pay down the mortgage, the principal is made available in the HELOC. So if you've got 20% equity and you've got that readvancing HELOC, that is all you need.
And you can reinvest the capital paid down on the mortgage into non-registered funds. This is important that it's non-registered because there are a lot of misinformation like, oh, I'm doing the Smith Manoeuvre, I'm investing in TFSAs, I'm investing in RSPs.
No, you're not.
That's not the Smith Manoeuvre. That's something else, and maybe that's appropriate. That's important that you look at that with your financial planner. Yeah. And this is anything that has to do with investments on the Smith Manoeuvre needs to be done with a financial planner. Anything that has to do with mortgage structure needs to be done with a mortgage broker. Anything that has to do with the tax needs to be done with someone that's a tax specialist, right? And that's where you're talking about the intersection where those professionals need to come together and merge the silos so they can work in symbiosis, right?
Together. Yeah. It's really important for professionals to stay in their lane. Like accountants shouldn't be giving investment advice. Financial planners shouldn't be giving mortgage advice. But it's important. I think the power that can be created in having a mortgage professional, a financial planner, and an accountant being in line with the strategy like this is really powerful. Yeah. Because I'm very fond of saying, being able to create an output without an input is something that's quite remarkable. Like if you go to a financial planner and you want to save for your future, the financial planner goes through your budget and he's like, well, you got to spend less or earn more, right? Because you got no delta. So this allows a Canadian to save for their future without impacting cash flow, and that's more relevant now than it's ever been.
I'm going to riff a little bit myself here.
Yeah.
One of the most popular products, or an up and coming popular product, which seems to be more and more relevant because more and more banks are getting into it. We have a recent large bank in Canada that started offering the reverse mortgage. This is a product that is sort of known because everyone that hears reverse mortgage, they think Tom Selleck, Chip, in the States, if you watch CNN, you probably saw a reverse mortgage, commercial.
Yeah.
And so what is a reverse mortgage? Well, it's someone that needs to live off the equity of their home, right, at retirement because they don't have significant savings. They haven't saved enough.
Yeah.
They don't have enough income. Their home is most likely the largest asset that they own. It's worth $1 million, $2 million, $3 million, depending on where you live in Canada.
Yeah.
And you're accessing that equity at retirement. And the two of the banks came out with statistics about how many Canadians are going to need reverse mortgages, and the number that they came up with, and this is something that I share a lot, is close to 70% of Canadians are going to need in retirement to live on the equity of their home.
Yeah.
And I think this is a very important point that a lot of listeners need to understand. There was also a survey that was done in the Quebec region asking consumers, and this is, remember, the number one thing that most consumers want to do, even though we can have a discussion about whether that's the smart way or not, is pay off their home as fast as possible. They all have this goal. Is it the right goal or not? Mm-hmm. That's to be discussed. But 56% of Quebecers responded in this survey that they would have to live off the equity of their home. Now it's probably much larger than that, thinking that if 56% of consumers recognize that this is the only way I'm going to survive in retirement, there's probably a few people out there that don't want to admit it. So imagine the ones that admit it, it's obviously a clear sign that they already know that this is possible. So the reason why I'm talking about this is that if you're questioning whether the Smith Manoeuvre is relevant either for your client or relevant for you, if you're 25, 30, 35, certainly if you have a long time horizon in front of you, mm-hmm. if we know that close to 70% of consumers are going to need to live off the equity of their home, why would you not invest that equity 30 years before you actually need to access it? Because if you're just paying off your home and then you access it, you lost how many cycles of potential compound interest and growth in the market? Many cycles. And this is a really important point, because if you're going to do it anyway, you're going to do it anyway. You're going to be borrowing off the equity of your home 30 years from now. You just admitted it, 56% in Quebec, 70%, close to 70% from the research of reverse mortgages. Another reason why many banks are getting into it, because they're like, this is a niche.
Well, Equitable just announced that they just came out the other day. A home trust, sorry. Yeah. So they're the fourth lender that's come into the channel.
Correct.
Yeah.
So, and this is where I think that's where the avatar is. It's look, let's take a look at your financial plan. Financial planner is gonna project what your retirement looks like. If it is evident that you're going to be living off the equity of your home, we should probably have the discussion from the mortgage debt side of creating a structure on the mortgage side to allow you to possibly invest that equity today. And from the financial planner side, project how that would look like, because of the fact that, okay, well, now if we invest that debt equity for 30 years, most likely 30 years from now, instead of borrowing off your home, you'll have created significantly more assets in order to even pay off your house and then live on the assets growth above and beyond the deductible debt that you now have. And remember, you mentioned it, all this with no additional output.
No, exactly.
That's a key point.
And so there has to be, we've got to look at this when someone signs up for a mortgage, they sign up for 20, 25, 30 years. So you have to look at this as a long-term strategy. The numbers, when you look at the numbers, just on the most basic version of the Smith Manoeuvre, what can be created over a 30-year period, it's huge. The numbers are huge. And to do it without cash flow, it's without additional inputs, just by optimizing the existing structures that exist for the meaningful reduction of taxation and interest costs.
Yeah.
And, but I kind of jumped in and pivoted. But you're right. Like the fact is, like you see it in the articles, like reverse mortgages have triple-digit growth year over year. We've got, and especially with the current population, we've got a lot of people that are equity rich and cash flow poor. So that is a huge growth industry, and it's going to keep going. But we've got this. I'm very passionate about, if we don't present Canadians with the option to offset their mortgage debt and with an investment strategy, they're actually saying no to a legitimate financial strategy that could have a meaningful impact in their life without knowing they're saying no to it. And so, once I think the experience I had 4 years ago when I came across the Smith Manoeuvre is once I've seen, you can't unsee the results of what it can produce. And I think that the concerning thing is a lot of Canadians and even professionals, like I speak with mortgage brokers and financial planners, and they might talk down to the Smith Manoeuvre or they say that they get it. And I ask them very basic questions. I'm like, cool, explain it to me. And they kind of get the mechanics. And
A lot
then
of misinformation.
And then I say, awesome. Like, how do you service? I go, this is a cash flow neutral strategy. It requires no additional cash inputs, but you're increasing the HELOC every month. So how do you service the interest costs on the credit facility if I'm telling you that it doesn't require additional cash flow?
Yeah, and they don't know.
Nearly nobody gets it.
Yeah.
And so when someone says they understand the Smith Manoeuvre and they don't get the most basic premise that essentially is the foundational core of how the whole thing works, this is one of the reasons why Robinson Smith rewrote his dad's book, Master Your Mortgage for Financial Freedom, and created the Smith Manoeuvre Services Professional Corporation, the SMCP designation, was to properly and deeply educate professionals across 7 professional classifications to really understand the depth of planning you can take it to.
Yeah.
There's, I like to refer to them as the 6 different levers. The formal name is we've got the plain Jane and the 5 accelerators. And these are different ways that we can speed up the debt conversion process. And the answers to the following questions will determine which are most appropriate. So when you understand, is the client salaried employee, sole proprietor, incorporated? Do they have non-registered investments? Do they have personally owned investment properties? And do they have non-deductible debt on a principal residence?
And so you've named a lot of things there. Just want to cut it up. And that's why multiple professionals are needed. Because right there, you talked about revenue properties. Okay, potential realtor.
Yeah.
You talked about investments, registered, non-registered, financial planner. You talked about mortgage structures. Obviously, if they own a house and they own all these rental properties, most likely they have mortgages, unless they bought them all cash, and that's something else to discuss. But most likely they have mortgages. So right there, you need to have those 3 specialists. And obviously, if you have rental properties, if you have investments, registered, non-registered, and then we're looking at integrating a whole plan around this, you're going to need a tax specialist in there as well to make sure that over time you're paying your taxes, you're responsible, and you're optimizing whatever benefits or reductions that you can get on that side.
Yeah.
So let's back it up a bit, because we went right into sort of the SMCP designation.
Oh, sorry.
What SMSC? No, but that's great, because we want to talk about it. What SMSC, which is Smith Manoeuvre Services Corporation, offers. To professionals. So let's talk about that national accreditation, because we talked about the Smith Manoeuvre. Yeah. We talked about how it's appropriate. But the problem is that there is a lot of misinformation out there. We just stepped out of a national conference, and regulators are looking at this, and they should, because they're there to protect the public, and it's important that professionals do things correctly and implement strategies that are appropriate for their clients at the right time. Yeah. And so this accreditation that is offered by SMSC to professionals across Canada at a cost, obviously, is important because of many reasons. So let's back it up and say, well, what does SMSC provide professionals? First, who are the professionals? Yeah. Second, what kind of services does SMSC provide to all these professionals? Because it's pretty wide.
Yeah, no, that's really important. So the 7 professional classifications: mortgage broker, financial advisor, investment advisor, insurance advisor, lawyer, realtor, accountant. Yeah. And they each can play a meaningful role in various aspects of the Smith Manoeuvre.
In their silo.
And at the very, it's really important for Canadians to have I truly believe at least one professional, ideally more, but one professional.
Ideally 7.
Ideally 7, right? Ideally 7, but at least one professional who really deeply understands the Smith Manoeuvre, and that they're communicating and collaborating with the client's other professionals. Hopefully if they don't have the other professionals, they can get access to it through the SMSC and through the Smith Manoeuvre certified professional program.
Can we agree that if you want your financial plan or your retirement to be a Formula 1 car, you need a team of experts at all levels. You need a driver, you need the specialist on the wheels, you need a specialist on the motor, you need a whole team working around the car when they come for a pit stop. Yeah. And so, you said at least one, but I think it's important that through the SMSC services and program, it brings together those 7 professionals where a client can come, a consumer can come and say, hey, I want to have a Formula One team around me so that my retirement is not a Honda Civic, very reliable car, not a Honda Civic, but a Formula One car that's going to perform optimally, and every team member is going to be focused on their lane, but also contributing to the global race, being the retirement as a whole.
Yeah.
So sorry I cut you off there, but the point being is like I think it's important. So let's dive into what SMSC offers to these
Well,
professionals.
that's just and you know, people hearing you talk about like Ferrari and Formula One. We need to really be clear that this is something that it isn't reserved for the wealthy.
No.
This is something that is completely accessible. Well, I mean, I guess you could consider people who own property wealthy, so it's not for those that rent, but it really
homeowners.
It has to be. It's accessible for every homeowner, and that's something that's really important. And there is a 0% chance when I'm speaking with a client that they're not getting introduced to a financial planner and an accountant that understands deeply the Smith Manoeuvre, because it's important to have that integrated advice, and it's very much available. Like we currently have over a couple of hundred SMCPs across all of those professional classifications, across all provinces, bilingual, French and English, to provide Canadians with that support.
Yeah. So what is SMSC as a company and an accreditation to SMCPs, which is Smith Manoeuvre Certified Professional?
Yeah.
What does it provide as services? So obviously, there's the general framework of this is what it's all about, but it's pretty deep. I mean, I'll let you talk about every single point, and maybe I'll add to it. But it's important that a professional listening to us that says, well, you know, I read the book and I can do this. And okay, maybe you can do it, but wouldn't you want to do it with a whole team, with a whole support? Talk to me about
you know
what
I
SMSC
could
does.
probably do my own taxes, but why would I? Because I'm not trained in taxes. I'm going to go to an accountant, right? I also use a lawyer. So I think. God, I went off on a tangent. And
no, but that's good. I mean, most people could probably learn how to do their oil change and change their tires as well.
Yeah, but you go to a mechanic. So I think, you know, we can talk about the specifics of what's included with the SMCP program and what we've built out. And, you know, credit to you, Ryan. I don't think we would have been able to achieve the depth of training and support without the architecture that you've brought into it. But if I was to distill it down to two key elements, which is what underpins the practical things that we can talk about, like the calculators and the templates and the trainings and the deal support, like all that stuff is important. The two most important things is firstly is to deeply train the new SMCP on everything to do with the Smith Manoeuvre. And I think the thing that's most misunderstood is just the depth of planning that you can take this to and the impact that can have financially. So really deeply training, but then supporting. Yeah. Right. So making sure that we're training you on it, but then we're also helping you execute and implement. So when you have a client in front of you and you're going through your first file, it's like, well, what's next?
Yeah.
We've got support for that. That's why we have weekly, you know, which we're going to make probably daily deal support calls so the professionals can come together. And we have financial planners and accountants and mortgage professionals on these calls together.
Yeah.
And what's been really great with the deal support calls is because we've got different professions on these training calls. The collaboration and the cooperation that sort of comes from it is really quite amazing. And so I'd say, like that's the essence, is to deeply train and then support with execution. And then we've got a lot of different ways that we actually do that, right? Yeah. We have weekly training, weekly deal support. We've built an entire custom-built ecosystem. So we've got discussion boards, instant chat, templates, marketing. Like it's really
social media marketing provided.
The whole, you know, we closed, you know, we closed down. We didn't take any new applicants for like 7 months. And for 7 months, we built out the infrastructure so that we could relaunch and make sure that we can support professionals properly.
And from a professional's perspective, being in an environment that you can create an expert team, and we talked about creating expert teams, and most, if you read anything from Good to Great or Jim Collins and sort of that reading on how am I going to grow my business out, you need to create amazing teams that work together. And so the SMSC network and the SMCPs coming together, creating financial planning. Imagine if you're a client and through one professional, you get access to 7. And all of a sudden, you thought you were just going to get a tire change, and you bring your car to the garage, and it comes out, and it got washed. It got an oil change. It got an upgrade on the motor. It got a paint job. It got a new windshield. You got a new sound system. Yeah. I mean, and that's what happened. I thought I was just coming here for a tire change, and then they hooked me up with all these new professionals for my car, which is symbol for my retirement plan.
Yeah.
And now all of a sudden, I'm completely heading a new direction. This is significant. And I think most people, most Canadians, and most professionals, across Canada that I meet, because we talk to hundreds and hundreds, they do work in silos. And I think this is a problem, right? Like, oh, I'm really good. I have a great financial planner. Okay, great. What are you doing for insurance? Oh, I don't know. What have you done for taxes? I don't know. Have you optimized your mortgage structure? I don't know. Have you spoken to a realtor that's a professional that has given you another type of investment? No, not really. Okay, well, shouldn't all these professionals come together for you and have these discussions? And then Canadians are sort of shocked, and even professionals sort of like, oh, I never thought of it that way.
Yeah, no, the siloed advice, the fragmented advice that Canadians are getting, it's the opposite side. The wealthy individuals, they have teams that they work collaboratively together. So my lawyer and my accountant, they are completely in step with each other, and we can make that accessible to everyone.
Yeah.
I think one thing that I wanted to mention before I forget it is, I'm from Australia, you can tell with the accent.
I didn't tell.
So I came here and I'd never heard of the Smith Manoeuvre, and someone mentioned, tax deductible investment loan. I'm like, I really don't know what you're talking about. Like, I hear what you're saying. I don't understand. But then I read the book and I was like, pump the brakes. This is actually, I'm a closet financial planner. I always wanted to be a financial planner, but I was always better at mortgage broking. And so I think the thing that really helped me gravitate towards the Smith Manoeuvre was I saw the financial planning potential within the confines and construct of delivering mortgage advice.
Yeah.
And so when I first connected with Rob Smith, read his book and decided to do the SMCP program, I was so excited. I would be speaking to maybe a first-time home buyer, and I would go down that rabbit hole and I say rabbit hole, I mean, it's like this client's calling me because they want to buy a house. And I could almost hear their eyes glazing over because I'm talking about saving taxes and building wealth and saving interest costs. And so I kind of learned through trial and error, what's the best way to communicate with clients around the strategy. And what I found worked for me really well was creating the intentional space to have the conversation. And so I'll just paraphrase it, but I'd say to the client, like, we're going to have two conversations. The first conversation is the reason we're talking, right? Purchase, refinance, renew, whatever that inquiry is, we're always going to satisfy that first. But I'd like to invite you to have a second conversation. And the second conversation is where we're looking optically at your mortgage as an integral piece in your financial plan, where we can look at it in the context of like your life and the impact that it can have on taxation, interest costs, and wealth building. Yeah. Because there are a number of different strategies we can look at based on your situation to kind of help integrate this into your life. Mm. Are you open to having that kind of a conversation? And that was paraphrased. It comes out a little bit differently each time.
But that was great.
Nobody says no to that.
No. So, are you open to meet professionals that will come together to propose a complete plan, looking at all silos, working together to a common objective?
You go to a bank and the bank's like, well, here's the 1 year, the 3 year, the 5 year, here's the variable. What would you like?
That's it.
Right. That's not enough.
Yeah.
And so the savings that you can achieve with even the most basic version of the Smith Manoeuvre, it blows those rate differentials completely out of the water. Yeah. We're talking about meaningful numbers, like hundreds of thousands of dollars of difference over a lifetime.
Conservatively.
And when you create that intentional space to have the conversation, clients really appreciate it because you know what? Ryan is talking to me. No one else is having this conversation. I go to the bank or I go to a different broker. Very few people are having this conversation, but it's probably one of the most meaningful ones. Your mortgage is the biggest liability that we have in our lives. For most Canadians, it's the biggest debt we've got. It takes up a huge percentage of our disposable income. Financial planners don't actually address it, and it's not their fault. Even if they, there's a whole conversation for us to have around unpacking the regulatory environments of what happened to the financial planning space after 2008. But it's a conversation that accountants aren't proactively having at scale. Financial planners are more concerned with insurance, investments, and estate planning, and that's fair. That's the framework they're given. Yeah. And mortgage professionals are loan officers. We help people get a mortgage to secure a property. And unfortunately, when you've got a strategy like the Smith Manoeuvre, it doesn't sit squarely in anyone's box. It has elements of these three professions. Yeah. And so I do find it kind of odd that something so remarkable has kind of slipped through the cracks a little bit. Mm. And that's why we call our information session the missing piece. It's the missing piece in in the integrated advice that Canadians are not getting but should be getting.
A puzzle where, most Canadians have the pieces but haven't put it together. They have a financial planner. They have potentially, if they have that, which is, that, they sort of have pieces of the big puzzle, but we want to sort of bring it all together and then see if the Smith Maneuver and its accelerators, because we've talked about the Smith Maneuver.
We haven't even talked about
but there's a whole bunch of accelerators in there that on their own are extremely powerful.
And they can be isolated.
And they can be isolated, exactly. So let's dive into maybe at least two accelerators for people that so there's the Smith Maneuver, great. Yeah. But let's say that the Smith Maneuver is not for you, and that's possible, right? I mean, I tell a lot of clients, look, we're going to talk to the financial planner, tax expert. We're going to look, but maybe we're going to decide that the basic Smith Maneuver is not for you. However, the Smith Maneuver derived accelerators that could be for you, and I see that you own a rental property, and there's an accelerator that we can do on our own if you have a rental property. So talk to me about just that accelerator, the rental property that involves if you own one rental property, one rental. If you are not doing this, because this is important, if you are not doing this and you own one rental, this is the one thing that you should probably take away from this conversation.
Maybe we should call it the Robin Hood maneuver, right? Because it's we spend a lot of money on taxes. Oh, thank you. We spend a lot of money. A lot of our income goes on taxes on our income, interest on our debt, and there's so many Canadians. They were single and they owned a condo or a townhouse, and they get married and they move into a family home. So as mortgage professionals or financial planners or accountants, we have a lot of clients that have the primary residence and maybe they've got one rental or two rentals.
Many Canadians.
And huge. And I find that one of the two following will apply. Either that person's somewhat organized, right? They have a checking account that they set up specifically for the rental. So rental income flows in, expenses flow out. Right? Nothing wrong with that.
We call that the classic structure.
Yeah.
It's well organized at least.
Yeah. Or they're less organized. The rental income comes into a checking account and it gets mixed up with everything else. They pay their expenses and the accountant works things out at the end of the year.
Yeah.
Now, there's nothing inherently wrong with those two options, but there's just a huge missed opportunity in creating a more optimized tax structure. And so the cash flow dam is really the reorganization of rental income in a flow that converts, going back to the original purpose of the Smith Manoeuvre, which is essentially, it can be distilled down to simply converting debt from bad debt to good debt, non-deductible to deductible.
Exactly.
And so the simple process is I'll dive into it. The rental income comes in. Instead of using it to directly pay for the rental expenses, you take it on a bit of a journey, right? Rental income.
Spend it on a vacation.
Prepays the primary residence mortgage, provided we've got the right HELOC structure in place. The principal reduction from the regular mortgage payment plus the full value of the rental income prepayment creates room in the HELOC. We re-borrow to service the expenses on the rental, because in Canada, if you borrow money with the reasonable expectation of generating income, the interest on that debt is tax deductible. If you have a personally owned rental portfolio, that meets the criteria.
It does. Singleton, if for all the nerds out there, the Singleton versus Canadian Revenue Agency, this was the landmark decision that allowed for this on the tax front.
And so what actually happens here is, if someone owns a rental portfolio, they've kind of already bought into the concept of using real estate to create wealth. The unfortunate thing is that the mortgage structure often isn't aligned with that vision.
Correct.
And the truth is that it can be. And so the process of the cash flow dam, which can be technically, when it's extracted from the Smith Manoeuvre, it's born of the Smith Manoeuvre, but it is not the Smith Manoeuvre.
Correct.
You can isolate the cash flow dam, and the results that it produces, they're phenomenal. We're talking, knocking 5-10 years off the amortization, saving multiple hundreds of thousands. What's actually happening?
These are real numbers, by the way.
They are real numbers.
This is not. This is for those. You do hundreds of cases. I've done hundreds of cases, and that those are real numbers. What you just said. You're not floating them around.
No. I remember when Jason Hennebury, years ago, when I first started training with Jason Hennebury, he showed me a calculator he created, and I said, "Are those numbers real? Is that legitimately real?"
Yeah.
And what's that saying? If I was zigging, now I'm zagging. I completely pivoted after coming across the Smith Manoeuvre and the cash flow dam. And it's what's actually happening is you're creating a new deductible expense that did not previously exist.
Correct.
That deductible expense is free, right? It doesn't require. It's just a reorganization of cash flow to create a more efficient structure. And the benefits are compounding because as you convert that non-deductible liability to the tax-deductible investment loan, the tax deductions increase year over year, which means the refunds increase or savings increase year over year.
Yeah.
And they can be used in a number of different ways, right? The Smith Manoeuvre, I think knowledge unfolds in layers. And as we deepen our understanding of a subject, we can sort of work out how to pivot. You have a great way of saying this. And you use the dancing analogy. Can you do that? What's the dancing analogy? Like you've got to learn the classical steps before you go out.
You go freestyle. So what I often tell professionals, whether it be financial planners or like that get the accreditation, there's the we're teaching you how to salsa, but before you start doing all kinds of crazy moves, you want to get the basics. And once you get really good at the basics, you can start freestyling.
Yes.
Now it's still salsa. You're not gravitating to you're not cramping or doing imagine I'm saying that or doing a merengue or ballroom dancing. You're still in salsa, but now because you understand the base mechanics and the base rules, you're able to expand and be creative with it.
Yeah.
So the if we go back to the designation, it teaches the basic dance moves very, very strictly and very well, keeping all professionals in line and making sure that we're teaching salsa to people that want to learn salsa where it's appropriate.
Yeah.
And then from there, we can expand to a bit of freestyle while maintaining the original essence of the dance. So
Exactly.
that's my analogy. Yeah.
Yeah, no, I love it. I always like when you do that analogy. And it's really just showing the client how to create this optimized structure. And if we were to line up 100 property investors, and I think I'd say 99 of them aren't doing it.
I know.
So
even small. When we talk property investors, this doesn't need to be people that own 6, 7, 8 property.
Just one rental.
If you're in,
the numbers are bananas.
For Canadians, this is important. For all Canadians, listen, for all professionals, this is aimed for obviously anyone that owns a rental property, but mostly, in my opinion, it's for the middle class that own one rental, one or two rentals.
That's the avatar. If you got a client that has a mortgage on their home, and let's be honest, they've got a big mortgage. Because we're in Canada and prices are crazy. The perfect avatar, and they're everywhere, is primary residence 1 to 3 rentals.
You will pay your mortgage off by just reworking the cash flow years and years before. If you're paying a marginal tax rate, let's just say at 40%, and you want to keep this simple, if I can convert your mortgage, your home mortgage, into a tax deductible debt.
Yeah.
Please understand this. Using the cash flow dam, using your rentals, and you pay 40% marginal tax rate, which if you own 1 or 2 rental properties, you're in that 40% range. Mm-hmm. Otherwise, you should start worrying. But if you're there, that means that essentially, really quickly, you're getting 40% off your mortgage. 40% off your mortgage. Now, if I told anyone in any business, if I told you you're going to get 40% off your groceries, you're going to get 40% off your car purchase, you're going to get 40% off, insert anything, wouldn't anyone be like, wait a minute, what?
I don't, why? What? It's just money that's been left on the table. We're struggling. I think most people it's just
execute.
just getting ahead. But just for Canadians, just like making it through the month without going backwards. Anything that we're able to do to relieve that financial pressure to help prepare for the future. We have to unpack that. We have to, because it's just, life is challenging. It's expensive. And governments and the banks, they make a lot of money off taxes and interest. And
that's okay.
And it's needed. But it's
let's create a win-win for consumers as well. While the government takes their piece and the banks take their piece, because I think, even for governments and for banks, you need to have a win-win. Like, it's normal that these entities make money. I mean, I hate when I hear professionals say things like, "Oh, the government's evil." Look, man, they provide a lot of services, and you need to pay taxes, but that doesn't mean that you need to pay too much.
Yeah. And when we can take advantage of completely legal strategies that are available to us, why not?
I've had the chance to be, essentially at the head of Smith Manoeuvre Services Corporation. So obviously the Smith Manoeuvre strategy, all its accelerators. Now it's been close to a year, and obviously one of the main things that I'm hearing across Canada are and that I'm receiving now are complaints from consumers about how they were mentioned the Smith Manoeuvre.
Yeah.
And now regulators across Canada rightfully have got a hold of this, and they're concerned because there are consumers that are saying, you know what, this wasn't done correctly. This wasn't proposed to me in the right way. I'm not happy. I want to make a complaint, and rightfully so. So I'd like to go into that topic and say, why is it for professionals that are listening to us and consumers, why is it important that they deal with someone that knows what they're talking about, and why the accreditation exists, and why we're extremely careful to work around regulation, around silos, to bring professionals together so that clients that do put into place these strategies are doing it correctly, are working with professionals that know what they're doing, and working with professionals that are talking about what they're allowed to talk about in their lanes. So I'd like you to touch on that.
It's an incredibly important one. And I just want to acknowledge the regulators have a really, they've got a really important and really challenging job, and they have to think of Canadian, they have to think of everyone. And so they've got a really important job that they need to do. And this sort of goes back to that point I made about speaking to financial planners and mortgage professionals that say they get the Smith Manoeuvre. And then I ask them the most basic question, like the foundational element of the process, and they don't get it. And so this really is a case of a little bit of information is dangerous, particularly when it comes to a sophisticated financial strategy that at its core is relatively simple, but in that simplicity is complexity.
Yeah.
And if you don't have someone that understands the complexity and the individual scenarios that each person has, and then how to apply the Smith Manoeuvre correctly to that person, of course things are going to be executed incorrectly. So I think that's where maybe the regulators' views and where the Smith Manoeuvre might sit out of favor with people is because people are out there saying they know how to help
and
execute it, and they're not doing it properly.
Or they don't have the expert team.
They don't have the expertise. They don't properly understand the strategy, and they're kind of just like advising clients on something that they've got very surface level knowledge of.
Yeah.
And that's dangerous. And so I think it's also something for us to acknowledge that it's charged. It's how, a big question is like, how do you evolve an industry? How do you involve a scope of advice that's so needed but doesn't squarely fit within the regulatory framework of industry professions? And that's really where the Smith Manoeuvre is coming in. It's
where the certification,
and that's why it's important. Like Rob really, he sold his investment business. He had this desire to rewrite his dad's book and create an advanced training program for professionals to properly support Canadians, because a lot of people were getting misinformation and half, bits and pieces and not really understanding how to execute it.
If you're a Canadian listening to this,
and that's dangerous. But this is why we're so passionate about, and we get pushback from brokers saying, "Oh, we're mortgage professionals. We're not supposed to be giving tax advice and financial advice." Of course we're not.
Correct.
We don't want to be giving the advice, but it doesn't mean that we shouldn't be talking more broadly about the role that your mortgage has in the context of your financial life, and bringing in the professionals to be able to provide it.
If you're a mortgage broker or if you're a financial planner, you should be exactly that point.
Yeah.
If your mortgage broker is talking about the Smith Manoeuvre, but is not introducing you to a financial planner that's certified and knows what he's talking about, or a tax specialist that can framework this, then you need to question that mortgage broker, and you need to also question as a Canadian, like, am I going to be able to do this effectively and correctly? And this is the reason why you also need to question yourself, well, is this person certified? Is he Smith Manoeuvre certified? This is not a joke. This certification has been created to bring those professionals together to make sure that every single regulated part per province of each piece of the Smith Manoeuvre is being done correctly and by a professional that is regulated to do his job.
Yeah.
And make sure that if he's not regulated to do the piece of the Smith Manoeuvre that he's not supposed to do, he has the financial planner there, he has the mortgage broker, he has the tax specialist, he has the insurance broker, he has the realtor if you're doing a cash flow dam. So if you're a professional implementing these things and you're not part of the network, I would be extremely worried that the regulator look at you and start questioning, hey, your clients are being misled, because yes, you're doing the investments correctly, but this entire tax side and mortgage side is completely a mess. Bad on you. And even worse on the mortgage broker side, hey, I've done this great structure and now my client's doing the Smith Manoeuvre in investing and has no tax framework and no financial planning framework to do this correctly. This is extremely important. If there's one thing that anybody takes away from this, it's for God's sakes, get the professional team in place.
Do not execute it with someone who's not a Smith Manoeuvre professional. And the unfortunate thing, and I find this is a conversation that I've had many times recently, where I was speaking to some brokers over the weekend at the Mortgage Professional Canada conference, oh yeah, I help clients with the Smith Maneuver. And I'm like, I've never spoken to you before. Like, what do you mean you help people with the Smith Maneuver?
Yeah.
And
when you start unpacking
and I unpack it, and this one broker who's like a $90 million producer, and he's telling me how he does the Smith Maneuver. And I asked him some basic questions and he didn't get them right. But he's also telling me that he's advising clients on the Smith Maneuver. That's dangerous.
And this is where the regulators need to step in and be like, unfortunately, you know, if you're advising and you don't have and you're just a lone wolf, and you're just advising on this strategy, which requires 4 or 5 professionals, you're not doing it correctly. I can tell you right away that your client is not frameworked right, and this is where the complaints come, and this is where, unfortunately, we get these emails because we're the national coast to coast sort of branded trademark brand of the Smith Maneuver, saying, "Hey, I'm doing the Smith Maneuver, and this is badly. I have a complaint." And then when we deep dive into it, this is not, you have a complaint, but you're dealing with professionals that are not certified, and it's working in silos, and yeah, you're right, and it's terrible. Some of the basic stuff like Smith Maneuver individuals doing Smith Maneuver, investing in RSPs, investing in TFSAs, that's not
mixing
the Smith
things
Maneuver.
that just should not be mixed at all.
I refinanced my house and I invested in the market $300,000 as a leverage. That's not the Smith Maneuver. That's a leverage loan, and there is a leverage aspect to the Smith Maneuver, but it is definitely not taking a lump sum in one shot and dumping it into the market. That's a leverage loan. It can be appropriate. Did you deal with a financial planner? Did you do a financial analysis to see if that's appropriate? Does it meet the regulatory norms in your province where you should be doing a leverage? I mean, it surprises me to this day that you know, this has been around since, you mentioned 1983.
Yeah.
That's still, you know, we have people out there getting misinformation, and so I think that was an important talk to sort of like touch on.
It really is. And so I think one area that we need to focus on, Ryan, is really talking to Canadians and unpacking the relevance of the strategy for everyone, investor mindset, and a discussion around the fact that it's not, you know, advanced planning and strategies isn't just for the wealthy. It's something that should be available to everyone. Yeah. And the philosophy of the Smith Maneuver is that this is for everyday Canadians, everyday homeowners, to get ahead financially. So let's spend some time focusing on that.
Yeah, I mean, we talk a lot about mindset and having an investor mindset. So what I really don't like in sort of the environment of when discussions occur in creating wealth is it's the us versus them paradigm, right? Like, oh, there's the rich and then there's us. And this is just, it doesn't serve anyone any good. It certainly doesn't help the us, and it certainly, you know, won't affect the rich or help the rich. So and whatever that means. I mean, what is rich, right? So let's just ignore that. Anytime anyone would hear anything of us versus them, oh, the rich do that, or you know, we should be acting like the rich. Forget all that, and let's just talk about adopting an investor mindset. An investor mindset from an early age means if you're a parent, you're talking to your children about potentially creating wealth in a different way or in any way, having those conversations. And when it comes to, in particular, the Smith Maneuver, I think this strategy available to all Canadian homeowners goes right into the heart of the subject, which is an investor mindset.
Yeah.
And so if you're adopting an investor mindset, your objective is at retirement to have the highest net value possible, so that you can retire comfortably and have the life that you want for your retirement.
Yep.
So what is that? What is net value? And this is important. It's net, which means that it's total value minus all liabilities, minus all debt. So, you know, when people say, oh, the Smith Maneuver, and we'll talk about leverage, right? The Smith Maneuver is going to leave you with debt. Yes, it's going to leave you with debt. We just read an article. 3 out of 10 Canadians are going to retire with a mortgage. 6 out of 10 Canadians are going to require their home as a retirement to facilitate their retirement.
Yeah.
So already this is occurring. So you know, what can the Smith Maneuver do? Well, it can potentially, if depending on the time horizon, create hundreds and hundreds of thousands of dollars in additional investments. And yes, you still have a debt, but you can pay that debt with the investments, and you're left with hundreds of thousands of dollars.
And options.
And options. You know, you never... I always talk to my clients about exit strategies. You never want to go into anything without an exit strategy. I mean, you know, if you're really paranoid, you never even want to go into a building without looking at where the exit is, because if there's a fire, you sort of want to be, okay, this is where I can exit. This is just smart strategic planning.
Yeah.
And I think that most Canadians don't look at their retirement in that way. They sort of say, okay, I'm just gonna save the classic way. And if you're listening to this, you probably realized already that the classic way is not working that great if you're in the middle class. I mean, you're paying your bills responsibly. You have no debt aside from your mortgage. Even maybe you paid your cars, that's great. And you're probably realizing that you're putting $2,000, $3,000, $4,000, $5,000 into RSPs, barely anything in TFSAs, or maybe the opposite. And your financial planner might be saying, yeah, that's great, you're going to be good. But if you actually project this out correctly, you're not going to be good. If you index it with inflation, you're going to be living off the equity in your home, and you may not even be paying your home. If now with property affordability, you're 45 and you bought your first house, you're on a 30-year amortization, and your payment is $5,000 a month. You might not get to the end of that. You probably won't. 3 out of 10 people won't. And that statistic's not going to get better. That's today.
Yep.
That's today. So people that are buying houses today, this statistic does not apply to you. This statistic applies to people that are stopping today. So fast forward this 20 years in the future, you should, if you're a Canadian or you're a professional managing or advising on Canadians' wealth, you need to be looking at this and saying, what kind of tools, what strategy can I implement that will not cost any additional money to the investor or to the borrower?
Yeah.
And will this help my client? And that's where the Smith Manoeuvre, I think, is an option to consider within the regulatory framework of your profession. And so yeah, I think.
And I think it's something that honestly, with the right advice and the right team around you, it's not going to be on autopilot, but you buy a house and then you just know that each month you just need to pay your mortgage. I mean, you're going to, we commit to a 20, 25, 30-year amortization when we purchase a property. At that point of time, and this is also why I think it's really important that this change or this evolution of this modality of planning being more available to Canadians, I really do believe that it needs to come from the mortgage profession, because we are the ones talking to the clients at the most opportune time to set these things up, because we're the ones talking to them when they're putting the mortgage in place. And it's at that point when they're assuming this new debt that we should be looking at, okay, you're about to take on a $500,000, $1 million mortgage.
Yeah.
Let's look at how this fits into your life over the next 30 years.
Yeah.
And it doesn't require, like, the fact that it doesn't require additional cash inputs, that we can offset your mortgage costs, interest costs with an investment strategy that will produce net wealth improvements over the amortization. We have to unpack that. And it can be done fairly easily. Like I'm quite passionate about every Canadian being given the option to offset their mortgage debt with an investment strategy. And one thing that I really like about the Smith Manoeuvre calculator, when you're going through the results, at the bottom there is this section, and it shows you precisely how much income a Canadian needs to earn to pay off their mortgage.
It's substantial.
It's big. So, depending on the marginal tax rate, and I'm just kind of going off memory here, but on a $600,000 mortgage, which is a pretty average mortgage size for a lot of markets.
Yeah.
You've got to pay back the 600, you've got to pay back the interest, and then you've also got the taxation on your income. And I think the numbers roughly on one of the recent analyses I did was a Canadian to pay back a $600,000 mortgage had to earn $1.7 million over their lifetime. So the true cost of the mortgage over a lifetime and the true impact of taxation. So taxes and interest are our biggest expenses. Taxes and interest are our biggest expenses. I'm saying that twice because it's actually really important. And the Smith Manoeuvre sits at the core of being able to help offset the impact of taxation and interest, so that we're keeping more of that money in our back pocket for our future. And again, just the subtle beauty of being able to do this without finding additional inputs when Canadians are struggling just to make ends meet. It's so relevant.
It is.
It's really so relevant. And I know we're talking about this now, but just I really want to hit home that it is accessible to every Canadian homeowner. Once you've got 20% equity in your property, you should be having this conversation.
Yeah. I'd like to integrate 3 concepts: the investor mindset, and let's talk about that.
Yeah.
I'd like to deal with the concept of leverage, the concept of leverage within the investor mindset,
Yep.
and the concept of leverage within the investor mindset, and the constraints of the regulations across Canada.
Yes,
So
that's a good
these
one.
three things are very critical, and I'd really like professionals and Canadians to understand that all leverage is not born equal, and regulators really need to start looking into the difference. I'm going to give a simple example using a Smith Manoeuvre accelerator called the debt swap.
Yep.
And so just so
This is
you
a great one.
this is so Canadians and professionals understand how this possibly makes no sense, and how regulators need to certainly be extremely careful with leverage when there's leverage to invest. Definitely. But to understand as well that not all leverage is born equal, and sometimes leverage is not even leverage. And this is really critical. And the debt swap, a simple example of debt swap.
The difference between debt conversion and leverage. It's an important distinction
subtle
to understand.
And let me give you an example for any professional, any Canadian that's listening, and you need to pay attention to this. It happens that some of our loved ones pass away, and we inherit a life insurance. And let's say you might be one of those individuals, and you've received a simple $200,000, $300,000 payment, inheritance, whatever it is. And you approach your financial professional, and you say, "I'd like to invest this $300,000. I've hypothetically, this example, I've maxed out on RSPs and TFSAs, so I'm going to put it in non-registered funds." And your financial planner says, "Yeah, let's go invest it. That's great." However, let's say you had a $300,000 or a $200,000 mortgage at the moment that you received this amount. Now, if you are applying the investor mindset, what you're going to do is you're going to say, "Hold on, I just got this $200,000. I have no RSP room. I have no TFSA room. I'm putting in non-registered funds, but I have a $200,000 mortgage. I'm not going to invest it right away. I'm going to pay off my mortgage first, have no mortgage. But I still want to invest it because I have like 20 years before my retirement. I could pay off my mortgage still, and I want to have this $200,000 gain in market growth for the next 20 years. But I want to be tax efficient." You mentioned that one of the most expensive things is interest and taxation. So I'm going to take that $200,000. I'm going to pay off my mortgage. I'm going to refinance my property right away afterwards. I'm going to take the money back. So I'm getting the same $200,000 back, and I'm going to invest in non-registered funds. Now, what's this going to create anywhere across Canada, aside from Quebec, because there's a slight nuance in Quebec, is that you're going to have a $200,000 tax-deductible mortgage for your home. You did the same thing as you were going to do anyways. You invest in non-registered funds, right? And now you've created immediately a 40%. If you're on a marginal tax rate of 40%, you've created a 40% rebate on your house just by a simple swap. We call this the debt swap. This is happening every day across Canada, and people are not doing this. So one, that's something to look at. Now, let's look at so that's the investor mindset. Now, let's look at the regulator part.
No, wait. Before we do that, can I give you an example?
Yes.
So one thing I think it's important to understand is that when you do the debt swap, you end up in the same place that you started, but you've got a tax-deductible expense. So I'll give you an example, and I'm going to give you a client scenario because I had the exact scenario you just came up with. I literally had that about 6 months ago.
I've had hundreds of them. Like this is not a joke. Lots of them.
Yeah. So they had a couple. They were going to purchase their first home.
Yeah.
And they had a very large down payment. It was like a $600,000 property. They wanted to do a $300,000 mortgage and $300,000 down payment. Through my conversation with them, I found out that the wife was actually expecting an inheritance more than the debt that they were going to take on the property. So I think it was like $400,000 or $500,000 that was coming down the pipeline. And I said, you know what, when you say it's coming, like how far away? Like, oh, well, like it's just in the mother's account. It can come over at any time. And I said, look, we can structure it the way that you're originally planning. So you can put the $300,000 in, we'll set you up with a $300,000 mortgage. But if you've got this inheritance coming and it hasn't yet been invested, I said, well, we could do the debt swap, and we did it at purchase. Now, there's a few different ways to execute it, but I'll tell you specifically what we did. I took them to Manulife. I set up the re-advancing home equity line of credit with their Manulife One product. I set up for $300,000, and so at completion, we set up the HELOC was drawn to $300,000. The following day, I had the clients pay that debt off to zero.
With the inheritance.
With
now,
the inheritance.
No mortgage.
No mortgage. They've paid the HELOC down to zero. No mortgage with $300,000 available. The following day, they took it out, gave it to their financial planner to invest. And the difference that the debt swap at the time of purchase made for these clients, they've still got a $300,000 mortgage, but they converted the debt in a single move. And if they take the tax savings, which are going to be quite substantial from day one, and apply them as prepayments on the mortgage, their amortization went from 30 years to like 21 without any change in cash flow. and saved them multiple hundreds of thousands.
How much is 9 years times 12 payments? So
It was huge.
You're looking at 96, right? You're looking at that 9 years, 12 payments. I mean,
It's meaningful.
you know.
And if that client went to a bank or a broker that wasn't familiar with this strategy, it would have cost them so much money.
108 payments saved.
Yeah. Yeah. So it's huge. And those sort of files like that, those sort of files are everywhere.
Yeah. So let's bring it back to the regulator.
Yeah.
So why are we saying that in all leverage is not born equal? Is because if you're a regulator, what happens for financial planners, and this is very true, and I need to for clients to and borrowers and Canadians to understand this. In that example where you've taken your $200,000 inheritance, you paid off your mortgage, and then you've reborrowed to reinvest it. So it's the same thing as if you invested. It's the same thing. You have the same debt,
same amount of assets, same amount of debt. You've just converted a large portion.
Now, for many financial planners and many regulators, you would not be able to do that. They would say, you know what? No, you can't. This is leverage. Wait a minute. Are you telling me that if I just didn't pay off my mortgage, refinance and put it back in the market, if I just took the $200,000, I got an inheritance and I just invested it, no problem? Yeah, that's correct. But if I pay off my mortgage, retake the same debt that I had and I invest it, now it's a leverage, and now I may not be able to do it with my financial planner based on, depending on a variety of factors, depending on which province I live in, etc.
Yep.
Yeah, exactly.
Doesn't make sense.
Do you understand how not all leverage is born equal? And so hold on. Like, what is leverage? And this is where I think regulators need to, at the same time, protect Canadians, but at the same time realize that, hold on, like in this case, if I didn't increase my total debt ever, where is the leverage?
Exactly.
And so you're removing how many hundreds of thousands of dollars of savings and potential wealth creation from Canadians because you're overprotecting them from something that is not actually occurring. And another example, using the Smith Manoeuvre as a base that I use with many financial planners, and how this doesn't make any sense, is, I have a client that came to me and said, you know what, my $400,000 mortgage, I'd rather invest all the capital. So what I'm going to do is I'm going to put my mortgage on an interest-only payment. Interest-only payment, I'll pay the interest, and all the capital I would have put towards my mortgage, I'm going to invest. Now, in this case, you can do that, but you'll have no tax benefit on the mortgage because you're not converting anything.
Yep.
And the regulator is absolutely fine with that. They are absolutely fine that you're not servicing your debt, your home debt in any way, but you're investing that capital. That's fine. But if you actually pay down your debt, pull the money back out, doing the same thing, and then reinvesting it, that's leverage, and that's dangerous. This is where the regulators just need to tweak their approach.
I agree.
And take an investor mindset saying, I'm protecting Canadians, I'm protecting borrowers, but not all leverage is born equal. And I think this is a critical thing that they need to look at.
It really, and when if someone that goes and takes $200,000 out of their equity and invests it in the market, that's leverage, right? Where you're leverage
10,000,
investing.
5,000.
But if you're in a position where someone is not increasing their debt by 1 cent, they're not increasing their requirement to service debt by 1 cent. This is the conundrum. So on the one side, we're not actually leveraging because the risk and the leverage was already assumed when the person purchased the property and got the mortgage. Okay, so that risk has already been assumed, that leverage is already in place. All we're doing is we're going through a process to convert it, and it doesn't require any additional borrowings and it doesn't require any additional cash flow. So technically, it's if I was to ask you a question, hey, is this leverage? And I say there's not going to be any more borrowing, there's no more change to cash flow. Like, are we leveraging? Well, not really. Where the technicality comes in is because of the process, we pay down the mortgage, the principal goes down, it creates room in a credit facility. We reborrow the principal from the credit facility. So technically, we are also
there is
leveraging.
Leverage. I wouldn't say that there's no leverage, but I would say that, I like the one, not all leverage is born equal. And there still needs to be a serious investigation of, is the strategy appropriate? Is the horizon of time appropriate? Does this meet the needs of any particular client? And this is where the financial planner needs to step in and make sure that it is appropriate. So anybody that just wants to implement advanced strategies, mortgage strategies that have a leverage-esque part to it, need to work with a financial planner, need to look if it's appropriate for them. That's for sure.
And this is actually a good time to segue into risks. So what are the risks? I think they can be classified into 3 broad classifications, and you let me know if there's anything else.
I like this.
Implementation risk, market risk, and liquidity risk. Implementation risk is kind of what we've already spoken about. That's the importance of getting professional advice from someone who deeply understands the strategy.
Yeah.
Because if you're not executing, the devil's in the details, right? It's simple in principle, but complex when you get into the weeds.
The Every Given Sunday, it's the last 2 inches, 3 inches. Have you ever seen that movie, anyone?
Yeah.
It's the last 3 inches that make the difference of being a Super Bowl champion or the runner-up. 3 inches.
And so, and to the point I mentioned about people that I've spoken to that said they're doing the Smith Maneuver, they're helping clients with the Smith Maneuver, but they didn't understand the most basic foundational principle of how to service interest costs. That's an implementation risk. So first of all, you can mitigate implementation risk by getting the right advice from a Smith Manoeuvre professional that works collaboratively with an accountant and a financial planner. So we can mitigate the risk through proper implementation. Market risk is the risk of the underlying asset being going down in value, or having to sell it in inopportune time. So if we zoom out, the Smith Manoeuvre has to be looked in the context of like the amortization of your mortgage. It is a long-term financial strategy,
and that's where the risk sits.
Yeah, exactly. But it's a long-term financial strategy, and we know that if you invest, wisely over the long term, you're going to have periods of negative growth, but ultimately over the long term, it should do well. And so any risk that exists in the underlying asset, that exists for any other type of investment as well.
Correct.
The real, like a key risk to really hone in on is like, okay, what if there's a marriage breakdown, or what if there's a separation, or something happens and we have to sell the property and wind back the strategy at an inopportune time? That is a risk.
Life cycle.
But that risk also exists in life.
Yeah.
And so again, with proper preparation and advice, you can mitigate the market risk
And have exit strategies.
fairly acceptably. And then the last one is liquidity risk, which is what asset am I investing into? And is it liquid or illiquid? Like, is it a property? Like some mortgage, some investments only allow you to sell it once a year, right? So just make sure that you're
even REITs that are illiquid, very good investments, but illiquid. So is that appropriate? This is where financial planners need to come in and make sure that all professionals are all cylinders are firing.
So I do feel like most of the risks, I think all risks can fall under implementation market liquidity risk. Do you feel like we've missed any there?
No, I think we've hit all those points, and this is very important. I mean, the storytelling is nice because it sort of sets the understanding of, the brain is kind of funny, right? The human brain is funny. We create limited thinking in all kinds of places. And I'll give you an example of something that happened to me with financial planners that I was invited to talk about the Smith Maneuver. Now, obviously, as a mortgage broker, I was talking about it from a debt structure implementation, and I was presenting to financial planners, and they were asking me, well, is it appropriate? And I was like, well, I mean, I'm talking to you about structure. You tell me, is it appropriate? And they were sort of mixed about it. And I said, well, let me just framework it in a different way, because they were saying this was during a year where mortgage interest was relatively high. And they were saying, well, everyone should just be paying off their mortgage right now because the market yields are lower, and the Smith Maneuver would not be appropriate at this time because the market yields are low and the mortgage rates are high. I said, well, it's an excellent point. I said, so let's do a survey. There's 60 of you in the room. Which one of you has told your clients to not invest this year and put all their money onto their mortgage debt? And not one of them raised their hand. And I was like, well, that's interesting, because you just told me that we shouldn't be implementing this long-term strategy because right now mortgage rates are higher than yield. And I don't necessarily disagree with it, but you all just said no to that question. Why? And they all answered the same thing. Well, it's long-term. Investments are long-term. Some years you're gonna have negative growth and higher mortgage rates. I said, well, that's exactly right. So and this is the same answer for the Smith Maneuver. So the answer is, if your investment horizon is very long, then we should be looking at this. Whereas if you're 2 years away from retirement and you have a mortgage, maybe you should be looking at securitizing your savings and effectively paying your debts. And this is case per case. But broadly crushing a strategy that where this may be appropriate simply because 1 year you have mortgage rates higher and negative growth was clearly debunked in about 10 seconds when none of them refused or none of them accepted to say, yes, all my clients should not be investing right now. They should be paying off my mortgage. And clearly that is a bad idea if you're 30 years old and we're in a year where interest is at 6% and let's say market growth is projected at 4%. Well, 10 years later, you might have wanted to invest that $20,000 that year instead of putting it on your mortgage because that 20,000 is now, doubled. It's at 40,000, and the interest cost would have been just 6,000, not even 3,000. Clearly, the money was better invested somewhere else. Again, this is case per case, but I think it illustrates very well that if you're looking at doing the Smith Maneuver, you need to be someone that's ready to be in it to win it. In other words, you're looking at a very long horizon.
Exactly.
And if you cannot tolerate market fluctuations, you should not be doing this strategy. It is not for you.
Yep. No, I agree. And I think the it's the earlier you can get into this, the better. Right?
And that's true for everything.
If you've got a shorter time horizon to retirement, you really got to look at the appropriateness and is there enough time? If you're less than 10 years, like you don't want to be retiring, because we all know that, when I worked in the financial planning industry, we used to say, for every 10-year period, you get what is it? You get 2 great years, like 6 average years, 2 great years and 2 terrible years. Like you don't want to time it where you're having to wind this back on a bad year.
Yeah.
So taking that long-term horizon, I wanted to say this before I forget it. One of the most common reactions I get from clients is like, why am I just hearing about this now? How come I've had a mortgage for 20 years. Why didn't someone tell me this before? There was a recent mortgage professional that enrolled in the program and I was on a Zoom call with him. He was visibly upset because we ran through his numbers. He has a rental portfolio and he wasn't aware of it. He was like, I could have been doing this for the last 15 years. So I think, and this is also important, like I made a comment earlier that if we don't present the options to consumers, to Canadians, they're saying no without knowing that they've been given the option.
Yeah.
And so I actually feel like it's our fiduciary responsibility to create the space, to have the conversation, to let them know what's possible. I don't do it with the intention of trying to sell them on the Smith Manoeuvre.
Be done.
No, it shouldn't be. But it's important to create the space to have a conversation so the client can understand this area of planning, and then it's for them to decide. My responsibility is to communicate it clearly enough that they understand that it's an option.
Yeah.
If they want to walk through that door, I will help them, but I'm not this isn't a product to be sold.
Yeah.
This is a long-term financial strategy. You made a really good comment about the appropriateness of advice, tolerance to risk. This is why you need a financial planner if you're going to be doing. So obviously, the rental,
have all your professionals.
the rental portfolio. Like if a client's not doing the investment side of the Smith Manoeuvre and it's just a rental property, it's a bit more relevant for a mortgage broker to take more of a prominent lead.
Yeah.
But anything to do with investments, like you got to have a financial planner that has the skills to do a risk profile and analysis to work out the appropriateness of the advice.
Yeah.
And you hit the nail so well in the context of just deepening the conversation with the regulators around not all leverage being equal. And maybe this needs to be unpacked a little bit more.
Yeah.
Right?
To make sure it's clear.
The Smith Manoeuvre got caught up in I'm not going to call it the anti-leverage movement. And I do want to acknowledge that the regulators and the compliance departments, they have a challenging job. But after the global financial crisis, like the Smith Manoeuvre caught on like wildfire. When Fraser Smith wrote the original book in the early 2000s, it caught on like wildfire. And then the global financial crisis happened. At that point in time, financial planning, the industry, like a lot of the financial planners were utilizing leverage strategies and mortgage strategies. So there was a reaction. There was a reaction to that where the regulators and the compliance framework changed within the financial planning industry.
Rightfully.
And yeah, exactly. The Smith Manoeuvre was caught up in that anti-leverage move.
Yeah.
Also, interest rates fell. And so it just kind of it lost the trajectory that it had within the financial planning industry. Accountants, they've got a lot of stuff to cover. Mortgage brokers are loan originators, and so I think this is one of the reasons why a remarkable financial strategy has kind of slipped through the cracks, because it kind of sits outside the traditional boxes that these professions sit in.
Yeah.
But it's and I know we've talked about this, and with Robinson. I feel like the Smith Manoeuvre has been around for pretty much as long as you and I have, right? Since the early 80s.
Birth. Yeah.
But it's more relevant now than it's ever been in any previous economic climate for Canadians.
Yeah.
So it's the perfect storm in a good way that this is really coming to the forefront again.
Absolutely. It's very good.